Are markets right in assessing that? Because if I connect the dots, history somehow has not been a true indicator.
Yes, I think markets are expecting a lot, and definitely markets are expecting a lot, and given the exit poll, most like.
I'll tell you what, Navneet, you'll have to just hold on for a second. We're having some audio problem, but bear with us. Navneet's not going anywhere.
Shall we?
Okay, I think the audio is coming back.
Okay.
Why don't you start?
So a lot of expectations from the new government, and in this hall only a couple of months back I mentioned that I see striking parallels between where India is today and where US was in late 70s, early 80s, where you had some kind of a stagflation, a lower growth and very high inflation. And I think over the last couple of years, and to a large extent probably it's self-inflicted pain of low growth and very high inflation. And I think what happened in US was that you got a Paul Volcker, and the way we have got Raghuram Rajan, who's going to break the back of inflationary expectations. And then US got Ronald Reagan in 1980, the kind of policies that he pursued. And I just know one sentence of Mr. Modi, that we need to move from lawlessness to less laws. We don't need too many of new laws, but we need better governance. I think to get this combination, I think it's a deadly combination. And throughout in the 80s and 90s, US had a period which is still known as NICE, non-inflationary continued expansion. And I think in next 10, 20, 30 years, if we get this combination right, and the policy prognosis probably that both of these are going to follow, I can visualize a period of 20, 30 years where we can really unleash the potential that this country has got as an economy. And I think to some extent markets have started discounting. Of course, earnings always follow, the macro fundamentals always follow. Markets are forward looking, and they have started discounting a lot that's likely to happen. But I think it's kind of a beginning of a bull market. I think it began last year. The bull market has begun, and I think it has a long way to go.
You know, when anybody says that the new bull market has started, the ring of that is always very nice for the audience and for all of us here. Nilesh, Navneet is making a case that look, the long-term story is intact, and you cannot question that. The problem is, what does one do in the short term? We are pitted against an important event. We've seen a one-sided move for benchmark indices, which are sitting at a record high. On paper, it's a frenzied move. Do you think markets, for the moment, are pricing in a stable government?
I think my equation for market is that Sensex divided by 100 is the number of seats which market is expecting BJP to win. So when Sensex was 18,000, market was pricing in that BJP will win probably about 180 seats. Now today it's at 23,800, so probably it's pricing in 238 seats. You can use this as a thumb rule to expect what market is expecting. But more importantly, I think what we should be looking forward is the steps which the new government will be taking to revive the economy, and how that will translate into better earnings and better growth. Our Sensex is just little above what it was in 2008, and earnings have almost jumped 100%. So from a valuation point of view, we have come down by almost half. Today there is not even one sector, including consumer staple FMCG, which is trading at its highest valuation. And there are so many sectors, including power, utilities, real estate, construction, which are all trading at its all-time low valuation. So you can't call this market in frenzy, which is trading near its historical valuation, which is down by half from its peak valuation, and where so many sectors are trading at lower end of valuation.
You told me the Sensex calculation and the BJP seat. Ashish is not there, so you can tell me the Nifty calculation also. Prashant, you know, historically it's believed that markets never react to the same events twice. Of late, or at least in last two precedences, the election outcome has been a binary event. Do you think this time around, given the setup we are staring at, are markets really prepared to handle the election volatility?
See, I don't think I am the best person to be answering this, because I have always believed that over short periods of time, markets are simply volatile. And I think we spend a lot of energy in trying to forecast short-term movements. And to my mind, it is futile. Because look at it this way, Sensex is compounding at 15% per annum, and your 100 has become 22,000. So if someone simply takes a longer term view of the Sensex, I think it is the best that we can do. And I have observed, and anyone can go back and backtest this data, below 15 PE investments in the Sensex have always yielded very good returns over the next 3 to 5 years. And one final point I want to make is that 1 year from today, the markets will not be impacted by the election outcome. It will be more driven by the earnings numbers and the interest rates. And I think earnings are being underestimated because corporate margins are today at a 18-year low as per a chart by Merrill Lynch. So I think the earnings should be higher than what we are estimating, and interest rates are at a peak. So I would be quite an optimist on the markets with a medium to longer term view. And one final point, let us not forget that index is broadly where it was 6 years back. So a lot of earnings, I mean the GDP has doubled in nominal terms, but market cap is where it was. So I think markets are fairly attractively valued.
That's a brilliant point, that rather than looking at where we moved and how much we moved and how fast we've moved, let's look at what lies ahead. And Sunil has been maintaining this point on various forums that look, Indian economy is on the mend. Why are you making a case that Indian economy is on the mend? I looked at the inflation data, the IIP data, the 10-year bond paper. There is no evidence that things are on the mend.
See, if everything were to be on the mend, then Sensex would be at 50,000, not at 22,000. The second thing is definitely the economy is on the mend. From a 5% current account deficit, we are down to 1%. From rupee struggling at 68 and reports coming of it touching 75 and 80, we are now at rupee at 60 and reports coming of rupee going to 55 and so on and so forth. We have, even if you see last 1 year, irrespective of what has happened in this phase of the government, a lot of things have definitely taken place. We have seen fuel subsidies being addressed in a very, very concerted manner. We have seen a lot of other, issues sorted out. Even on the corporate profitability front, despite what has been the situation, both in terms of the global outlook as well as the macroeconomic situation in India, last 2 quarters we are seeing earnings growth of almost 15%, and this is despite the demand scenario being very benign and interest rate being at such a high level. So very, very clearly, yes, there are a few numbers which are not what we would like them to be, but there is now possibility of only improvement in those numbers. So we are already in that hockey stick curve where you have started to inch up, and all it needs is some catalyst for it to propel it higher. So we will definitely maintain that. We are definitely on the mend.
Naren, are you getting this feeling of deja vu? Are you getting butterflies in your stomach simply looking at the way our markets have run up? It's been an extraordinary move. 400 points on Nifty in a matter of 3 trading sessions.
If you take investor positioning in the last 1 week, any person from my company has met investors. They've been talking about the markets, and that too talking about equities after years. So there was a feeling, okay, now the shoeshine buyers started to talk about equities, but when we reflected more into that conversation, it was that none of them had invested in equities at all in the last 7 years. So there's a left out feeling and they're not invested. So we are in this tragic situation that everyone is underinvested. At the same time, the markets are at all-time high, and people have put all their money primarily in gold and real estate over the last 7 years, which is now meaningfully underperforming equities. So there is a left out feeling. But what happens is, thanks to the fact that we are a very global market today, we might get opportunities maybe due to El Nino or some other event in some other part of the world. But during those periods, if investors again get active and start investing, I think they may not have missed this bull run. But certainly the time to really invest in a big way was 6 to 9 months back, because you had blood on the street. But to invest when there's blood on the street is never easy in equity. That's what the reality is.
So good news and good price rarely comes together. Right now news is good, but our prices are good.
See, there I would say that if you take the mid caps and small caps, they have underperformed for a very long period of time. They have not gained by dollar going to 65. They have got hurt by high interest rates. So if you see the large caps, there are a lot of them who gained by both dollar going up and also by interest rates being high, because they're all cash rich companies. So I think the real opportunities are in mid caps, small caps and infrastructure.
Dharmesh, what is the India pitch like when you interact with your global clients? How are you selling them India?
Well, I think so. The people are still waiting for this event to happen on Friday, as exit polls are never an indication, because they've been horribly wrong in the past. But once you see that is over and people see a stable government, I think the people will be surprised with the kind of money which can come to India. And also remember, India has not given any opportunity to foreign investors to come in. They have been forcibly coming in because there is no other destination. A day will happen when India will actually welcome them. We have large deals, as what Vallabhbhai said, that we have not seen any great deals. So this kind of deals will attract a lot of foreign money. The FDI is virtually absent. That will come back to the markets. And I think the people have forgotten a bull market. We have been in this market since the last 4 to 5 years. So virtually a bull market is forgotten how it starts and how it ends. So I think so it's just in the beginning of this phase. It all depends how the next government comes in, what kind of announcements they make, and what kind of opportunities India creates for itself to attract this foreign money. Money is not an issue.
So let me throw some numbers at you. We got about $5 billion YTD. We got more than $20 billion last year. Assuming that we get a stable government, hope will come back. So what kind of money do you think we could be staring at?
It's difficult to get a number, but just to put it in context, obviously not the right reference, but a Reliance Power IPO, I remember in 2007-8, attracted almost $135 billion worth of investment in one single deal. So the money, when it comes, it can be unlimited. I'm not saying same thing is going to happen very soon, but that's the kind of money which can come in when markets go crazy. You're still not even in the start of this craziness. So I think so there can be huge amount of money which can come in. Like we've not seen any deals which are coming of $5-10 billion. Those deals will be lapped up in a day or two. So I'm sure, like you saw when Axis Bank block sale, it got lapped up in 2 days and the stock is up almost like 20-30% post that. So if they get good opportunities, money is not an issue.
Naren, how seriously should we consider central bank policy action? Because for last 3 or 4 years, the big driver for Indian equities has been central bank policy action. The fact that BOJ, US Fed and ECB have followed a loose monetary policy, indirectly that has benefited us. Now that Fed is committed to dial down their asset purchase, will that impact us?
See, last year when quantitative easing was tapered off, there was a lot of feeling again we'll see rupee going back to 65, 66. It didn't happen. Frankly, if the day our current account deficit goes back to about 3% of GDP, I think we'll go back to a situation where we have to worry about global central banks. But with the current account deficit, there is no problem of global central banks because we don't even need capital to fund our current account deficit at this point of time. And I'm sure Reserve Bank of India must be buying dollars every day because we are now possibly a capital account surplus country at this point of time. So I think what matters to us, we can't have industrial production growth at 0% for the next 2 years. Clearly we need to see that accelerate back to 5 to 6%. In India now, petroleum consumption and power consumption has grown very, very slowly. I think they have to also go back to 4 to 5% and more in the case of power. So I think a lot of economic indicators have to normalize itself. But I don't think we should be so much worried about global central banks as we should be worried about the fact that even today industrial production is coming at minus 0.5% and our petroleum demand growth is close to 0, particularly of diesel, which must be an important fuel to determine Indian economic growth.
Sunil, we like it, we don't like it. Secretly all of us are of the view that look, the new regime will be beneficial for us. Let's try and understand that what the new regime could do. What are the low-hanging fruits which the new government could pluck? What are the policy bottlenecks? If sorted out, it will add to earnings, it will really contribute to the GDP.
See, frankly, we don't have a view on what government will finally come in. As Dharmesh mentioned, that there can always be surprises. But as I said, last 1 year already a lot of... No, I'm not saying that. We'll definitely, we are an optimist and we'll obviously have a great leadership for this great country. What I'm trying to say is that anyway, last 1 year, a lot of steps have already been taken. It had been late in the last term, but at least that start has already happened. Going forward, the low-hanging fruits obviously are to encourage entrepreneurship. We as a country have grown because of entrepreneurship. Most of our country, starting from Dhirubhai Ambani to all the others, there's a clear sense of entrepreneurship which has driven industry, which has driven GDP growth. And I think somewhere in the last 4 or 5 years, that entrepreneurship got a shock. They all went into back foot because of various issues pertaining to a lot of things. So I think the low-hanging fruits are, one, to start behaving in a manner which encourages entrepreneurship, rather than forces the entrepreneurs to go on the back foot. I think that is the biggest low-hanging fruit. All the other stuff of infrastructure and this and that is, I think that is regular stuff for any economy. It is not something which you need extraordinary sort of a force to do it. That's the duty of any leader towards the nation and towards the public. Good roads, power, and all those are needed. And yes, we have been deprived of that. Hopefully, the new regime will look at that. But I think the biggest force for this country is the millions and crores of entrepreneurs who can drive the GDP growth, who can drive the IIP numbers to 4-5%. And I think that is what at least we would expect the new government to do.
What you're telling me is perfect economic theory. What I want to know from you is perhaps what are the data points which you would be mapping which will give you confidence about Indian stock markets?
See, markets are not always economics. If you say that, oil will be at 40 and markets will go up, and oil will be at 150 and the markets will go down, does not work. We had the peak when oil was at 140 and we had the bottom when oil was 30. So pure economic theories don't necessarily work in the markets. I think what works is the trend. And as I said, across macroeconomic trends, things are positive. From the government's perspective, yes, there should be definitely an effort to bring down interest rates. But yes, you need also the inflation to come down. So it's not that you just need willpower, you also need to have factors which flow with you. And you need luck. Vallabhbhai mentioned about El Nino. I don't know what is going to happen with El Nino. With a little bit of luck, oil, which is fundamentally very weak internationally, and the price is whatever it is because of what is happening in Ukraine, Crimea, sometimes in Middle East. I think with a little bit of luck, if you have oil fall by $10, $15, $20, then a lot of these would become very easy. So I think we have to take it dynamically. Right now what is needed is that we need this country to have some kind of a sentimental boost. And I think that is what the low-hanging fruits would be.
Right. Prashant, in your initial remarks, you alluded to the fact that you expect earnings to surprise, margins to expand. What is fueling this thought? Because again, I have to look at anecdotal data, demand versus consumption. Investment cycle is broken down, high inflation is eating into consumer demand.
No, that was the past, and see, it is only the consumer sector where margins are close to all-time high levels, but it is just maybe 10-15% of the index. So we are, I think the balance 85% is also very important, and that is where the margins are really depressed. And so we have had high cost inflation over last few years. We have had currency depreciation, which increases all costs over time. We have had very high interest rates, and we have low capacity utilization. And today, if capacity utilization is low, whenever the demand improves, whenever capacity utilization improves, operating leverage will help you expand the margins. So I think all these factors which have hurt margins, these four factors, they should be more supportive of margins improving going forward. And I think this is what has happened in last 2 quarters. If you look at last 2 quarters, other than the consumer companies, post results, virtually every single sector has moved up. And I think one of the reasons could be, I am not saying it is, that the results are maybe slightly ahead of expectations. So I think that trend is already begun to play out in my opinion.
Prashant, what we've seen this year is a huge mean reversion. Industrials, cyclicals, PSU, PHU, banks have, all of them have made a roaring comeback. Some stocks are up 50%, some stocks are even up 100%. Do you think bulk of the mean revision in economy-related stocks, that's an important question, please pay attention here, is that over?
I don't think so. I mean, if you look at if you plot the price to book value multiples of any corporate bank in the country, I don't think it will clearly tell you it is not yet over. I mean, what have we seen? I mean, some of the leading corporate banks, the prices are still below where they were either 6 years back, or they are where they were 6 years back.
Fair point.
So, I mean, in these 6 years, book values have virtually doubled. So that clearly tells you that, in my opinion, with a medium to long term view, I don't think it is over.
Nilesh, you put a lot of thought behind the debt market, and I'm sure you spend a lot of time trying to analyze where the 10-year paper is moving. The 10-year paper historically is an important indicator of what equities would do. That's the benchmark on which equities always rally. Things are looking up. The outlook is positive. There is an air of optimism, yet the 10-year is not down in a meaningful manner.
I think if we see 10-year government securities history, we need to factor two things. One, what we see as a benchmark security keeps on changing every 6 months. So many a times what we currently see as a 10-year security in terms of yield probably changes when the benchmark changes. The second thing which we need to remember is that over last 10 years and 15 years, only about 7% of the time 10-year government securities have traded above 9% yield. So sometime back when 10-year yield was trading around 9%, it was in that quartile or decile where it was there from an historical point of view, the top end, and from there the way could have been only down. Now clearly RBI is today looking to kill inflationary expectation. For last 3-4 years we have seen persistently high inflation, and there is limited thing which you can do on inflation side. It's better to kill the inflationary expectation if you can't manage inflation per se, and by pursuing slightly tighter monetary policy for a longer period of time, RBI is removing the inflationary expectation. What Navneet mentioned in terms of what Paul Walker did with American economy, we are probably seeing a repeat of same in Indian economy. But my guess is that over a period of time, the cycle for interest rates will be on the softening side. We have seen a small trailer from 9% becoming about 8.70%, and this will probably go towards lower level after a gap of few months. The other interesting thing which we need to see about interest rates is the fact that in many parts of the world, lower interest rates are in some sense supporting the growth. So in India, what do we spend maximum money on? The government of India spends 40% of its revenue, of its taxation revenue, by way of payment of interest. And what is our federal debt to GDP ratio? Just about 40%. Now in Japan, federal debt to GDP ratio is 200%. If they were paying as much interest rate as India is paying, then they will spend 200% of their revenue by way of interest. Obviously, we can't afford this high interest rates forever. So whether we look at from growth point of view, inflation point of view, or purely from deficit point of view, lower interest rates are necessity for this country.
Why do you think the 10-year paper will end this year?
31st December?
31st December.
More likely to be between 8 to 8.25%.
Okay. Navneet, even though we have a packed house here today, you know, when I was walking in to the BSc hall, a fine gentleman walked up to me and his query was that, look, I'm really an unlucky man. I got a tip from a friend of mine, I ignored the tip, the stock went up. Second time I got a tip from the same friend, I ignored the stock went up. Third time, I followed my friend and the stock went down. So the problem with a lot of this captive audience, and I'm sure the retail audience who's watching the show, is that they suffer with this commitment phobia. At 7,000, how should a first timer really invest? You know, we've got all kind of crazy numbers floating around saying, look, Indians are underinvested in equities. But at 7,000, should they take that deep dive?
I think rather than taking that view where the Nifty is today, I think several people sitting here managing money for 10, 15, 20 years, and we look at the track record, how the equity funds have delivered over a period of time. Unfortunately, I mean, I just go back to 2008 and 9. In those 2 years, domestic institutions invested $30 billion. And in 2012 and 13, we sold $20 billion. So that's the timing that the investors do. Rather than trying to time the market, I think if we have that long-term faith and stay invested throughout this period, I think that's the way to make money in the equity market. And I think if you are thinking of a revival in the whole economic cycle, and if you think that this cycle can be a lot more extended, then probably whatever is the Nifty levels, I think over a longer period, we can make a lot of money by finding the right kind of stocks. I think in India is a probably, I keep saying that, is a stock picker's paradise. Regardless of where the Sensex or the Nifty moves, there's always a great opportunity of buying 30, 40, 50 companies for a portfolio, which can deliver substantially higher than the inflation or where the bond yields are over a period of time. And I think you need to have that faith in the equity market, find that right manager and stay invested.
You know, when fund managers talk long term, even telephone phones react. So someone's phone is really buzzing. So why don't you put it on silent? And I'm just going to check my phone, it's not buzzing. So gentlemen, please check your phones. I know Navneet is trying to talk long term, but please bear with him. Okay, I think we are sorted there. Prashant, I'm going to throw this question to you, and let's talk a bit about style and what could work in the medium term, what could work in the long term. If I take a deep dive or deep look at your portfolio, you've taken a concentrated bet in PSU banks. Yes, he's bought into PSU banks. No one likes PSU banks, I can see that. Okay, Prashant. With a bit of an audio problem, even BSE people get surprised when somebody is talking about PSU banks. Why have you bought into PSU banks? What's the thinking behind this? Because that's a brave call.
No, I don't think it's right to just focus on the ownership of the banks. I think my approach is that in India there are two types of banks. One is the corporate banks and one is the retail banks. And corporate banks are banks whose most of the assets are lent to companies, big, small or medium enterprises. And there are retail banks where most of the assets are in retail assets. And we have seen for very clear reasons that in last 4 or 5 years, most of the stress has been felt by the corporates, and household balance sheets have still been reasonably healthy. So we have seen really huge stress on in turn the balance sheets of the corporate banks. But I am an optimist, and yes, the economy on the downside and particularly after tapering took one by surprise. But fundamentally I think India is a secular growth economy, and these banks have a history of generating return on equity above their cost of capital, and I think it will come back. If you look at the provisioning levels of all corporate banks, whether in the private sector or the public sector, they are at record high levels, and this level of provisioning will not continue as and when the economy improves. And if you normalize the provisioning, if you normalize the profitability, I think most would agree that there is value in these banks, and that's why we are holding on for that point of time when these banks earn fair profits and they are fairly valued in the market.
Are you happy to own them for next 3 to 5 years?
It depends on how fast the economy moves, on how fast, how market values them, but as long as we think they are reasonably valued, undervalued, we will try and own them, yes.
As of now, you're comfortable owning them?
Yes.
Sunil, again, if I scan through your portfolio, you run a portfolio which is really skewed towards pharma, something which has worked for you. Do you think there is still money to be made in pharmaceuticals, especially looking at the recent run-up and given what is happening to the rupee?
I think what we have tended to do is, one, we are significantly underweight the consumer durables segment, because we feel that at 5% growth rate to give a 30-40 P to the consumer side is definitely not warranted. And we have tried to sort of balance it by our overweight on pharma. There are 2-3 aspects to it. One, pharma companies are growing at upwards of 20-25% for the last 3-4 years, and our view is that over the next 2-3 years at least quite a lot of them would continue to grow there. Second is pharma companies have created scale over the last few years. So if you see companies whether it's Sun Pharma or Lupin or Dr. Reddy or some of the others, now have significant size in terms of profitability, in terms of their reach in the US, which is a predominant market, and other markets. I think third is even domestic pharma is a big opportunity. To just give you some number, the total market size of medicine in India is only 70,000 crores. One drug of Pfizer, Lipitor, which before it went off patent, used to have a sale of 80,000 crores worldwide. So one drug is equal to the total market as far as pharma is concerned. And we now all pop up tablets left, right and center, which was not the case earlier. So I think that has been the logic. Going forward, everyone expected the rupee to fall to 55 if there is a government. We are seeing rupee stabilize at 59.5, 60. Our view is that both on pharma and IT, people have significantly sold off because they wanted to buy banks and they wanted to buy capex goods and they wanted to buy 10 rupee infrastructure stocks and so on and so forth. It's a matter of time before people realize that IT is trading at 13p with free cash flows, or pharma is trading at 15 or 16p with again free cash flows, and they would revert back. So I think it's a call that, one, we have to have a balanced portfolio. It's a good sector going at 15-20%, and we are to some extent balancing it with our agenda.
About US FDA, you're not worried about rich valuations, because across the board, with the exception of maybe 8-10 pharma stocks have literally doubled or quadrupled.
Any company which is following unethical practices should be worried. So if you are not following the standards of quality, then whether you are in a pharma company or a metal company or XYZ company, you have to worry. And companies which have done well have been immune with all this FD issues. So you see, you yourself mentioned, companies have doubled or quadrupled because they have followed ethical practices. One drug success changes the complete complexion as far as the pharma is concerned. And till 2019-20, the pipeline of drugs going off patent is immense.
So will pharma be part of your core portfolio for next 3 years? Are you happy to own it? Do you see enough earning visibility there?
And having said that, we also have cut a little bit of it because we also need money to buy something else. And unfortunately, fresh money is not coming in because Axis is not pushing it hard enough. So hopefully, money will come to the mutual fund. So when you buy new stocks, it would not be by selling some of our stocks. But we continue to be positive, very clearly.
I should actually turn to Nilesh Shah. Nilesh, you've heard 3 fund managers. There are a lot of your prospective clients who will come to you maybe after this conference and they'll say, Nilesh bhai, tell me one mutual fund to buy. Should I buy Prashant, Naren or Sunil? And Navneet.
Sure.
And you have option to pick one.
So I want to ask a question to audience.
You have to give me one answer.
Sure. So I want to ask a question to the audience. Before coming over here, I did this little analysis and I call it Alto to Ferrari. So here are 4 fund managers. They manage fixed income as well as equity. And you have a choice of investing in their fixed income funds or equity funds. And assuming that you invested in 2001 or 2005. So 2001 to 2014 is about 13 years. And 2005 to 2014 is about 9 odd years. And if you had 1 lakh rupee to invest, in that first segment, the average equity fund has outperformed average fixed income fund by between 4 to 7 times. So on 1 lakh rupee, you could have earned 4 lakh rupee to 7 lakh rupee extra. That's Honda City for you. And if you had invested in a smaller time horizon of 2005 to 2014, the average amount would have been 2 to 3 times. That's Alto for you. And if you had 1 crore investment in fixed income fund of this 4 gentlemen or their equity funds, there would have been Ferrari in the first case or Maybach in the second case.
I want to buy a jumbo jet. Which one should I buy?
So I'm sure there is enough opportunity for us to invest, and there are many good funds, including Axis Mutual Fund. So do invest across all the funds. But most important thing is that as retail investor, just about 6% of our balance sheet is invested in Indian equities. Balance 94% is invested in debt, fixed deposits, insurance and so on and so forth, and it does not include real estate. So there is a tectonic shift happening in allocation where people will move from physical assets like gold and real estate into financial assets, and within financial assets from debt into equity. Now, do you want to be a last man or do you want to be the first man? That's the call you have to take.
Prashant, just for the benefit of this audience, and again, it's not a sales pitch here, why don't you walk us through the benefits of long-term investing? We often tend to overlook at it. We often tend to criticize fund managers as guys who underperform the benchmark indices. Media, and including some of my friends, we are quick to criticize that. What we don't realize is that by simple SIP planning, the amount of wealth some of the good, well-diversified schemes have created. So 30 seconds for the sales pitch.
No, 30 seconds is too small. In fact, I think we pay undue attention to timing the markets and to security selection. And fact is that these two put together do not impact more than 10% of your wealth over long periods. Over long periods, the only thing that matters is asset allocation. Even if you invested in the worst performing fund 10 years back, you have still done wonderfully well compared to a bank deposit. See, bank deposits are compounding on a post-tax basis at 6 to 7%. And you know how much you can grow at 6 to 7%. The Sensex itself is compounding at 15% per annum. So I am sure you can do the maths that over every 5 years, 10 years, you compound at 6 and you compound at 15, what difference does it make? On top of that, I think there are a number of funds in India. In fact, a very large portion of mutual funds have beaten the benchmarks between 3 to 8, 9, 10% per annum. So I think the key is asset allocation, and unfortunately, due to whatever improper understanding, I think we spend 90% time on either timing the markets or security selection. Instead of that, we should be spending more time on asset allocation because it is well established by several studies globally that more than 90% impact on one's long-term wealth is made by asset allocation and not by timing or security selection.
And before I go, yes please.
You know, Nilesh mentioned 6%. I think our study says that only 1% of the net wealth is in equities.
That's it.
And for that 1%, we analyze 99 factors. And for the balance 99%, we don't even analyze one factor. So I think that is something which we just need to get rid of.
Naren, a cue for you, I guess. For someone who's suffering with the commitment phobia, and let me assure you, a lot of people who are watching this show, a lot of members of the audience, they want to invest, they don't have the heart to invest, they don't have the courage to invest. Why should they invest now? Like you said, you should always buy fear. The fear is over. It's 70-200 on the Nifty.
That's why we look at maybe conservative equity investing at this point of time. We tried our best to collect money when the markets were cheaper than what it is. Between systematic investment plan and conservative equity investing, there is still an opportunity which you don't need to focus on in timing. And frankly, the issue is that we have a 6-month thinking that in the last 6 months markets have done well. But if you see mid caps or large caps or infra funds, they have not done well for years. So the opportunity may be that at this point of time they still exist in these kind of spaces.
Why do you think there is value in mid cap? Because in beginning of an economic cycle, large companies, they normally do well. Companies who've got a balance sheet size, companies who can retire their debt, companies who can monetize on early demand. So typically when a new bull market starts, stick to large cap, stick to quality. Why just jump up and down?
No, the reason is if you see India, most of the top companies have got beautifully globalized, and which was one of the reasons why the earnings of the Sensex never got affected in the last 5 years. Many of them are dollar earners, many of them have cash surpluses, many of them are global businesses. The small caps are the people and the mid caps are the people who really suffered with the bad economic environment. So they are the people who have really suffered between 2007 and 14, and therefore the opportunity when the economy revives is with them. The easy returns obviously was the large segments that have been made in large caps. So I believe that going forward to expect mega returns in large caps with such globalized companies doesn't look to be very easy, whereas if you're looking for decent returns, small caps, mid caps and infrastructure segments give you much better opportunities.
Dharmesh, foreign institutional investors historically, they have always invested in quality large cap stocks, be it IT, pharma or banks. Are you getting a sense that now they are eager to maybe go down the value chain, they are eager to really look at economy related stocks? So if a TCS has done very well in last 3-4 years, maybe now L&T could do well, maybe it's time to look at SBI. Are you getting that sense from your clients?
No, I don't agree to your statement that the FIs only look at the large caps.
That's all myth.
That's a myth. In fact, you will see even the FI holding the mid caps is very large. It's just that mid caps are illiquid. So you need that stability factor on which basis they will invest in India. They need a stable government. The environment has to be good enough for them to invest in, and there are not too many shocks to the system. India had humongous shocks in the last 5 years. So they were tired of it. That's why they went to the safer one, which are liquid, because emerging markets itself were volatile. If India gets the stable government, what we all are hoping for, you will be surprised the kind of breadth which will expand in India. You will see people going down because those stocks are still cheap, and the growth there can be phenomenal. The large caps may be priced in up to a certain extent. So obviously the valuation is much attractive in the mid cap stocks. And just one more anecdote which I've been seeing lately, I was there in London last week, and interestingly a lot of my clients, especially the pension funds, have started giving money to a lot of Indian mutual funds or the India dedicated funds, which I have not seen in the last 5 years. So clearly you are going to give Indian dedicated mutual funds or funds to invest only in India, understanding that they're going to invest in the mid caps, not in the large caps, because they can directly do that. So I'm sure there will be a lot of money coming into the mid caps and small caps. And remember, the mid caps always become large caps when they go up. So obviously you're trying to find a large cap in a mid cap.
In a bear market, large cap becomes small cap also.
Well, we are specialists of that also. But that's what I said, Nikunj. What do you believe? Are we in a bear market or in a bull market? So I think so the bear market phase is gone. It's just a matter of when that belief comes in the bull market and when it takes off.
Prashant, let's talk about absolute theory, something I learned in my MBA class, that in a bull market index normally doubles. If the general belief is that we are in a bull market, or maybe the bull market has started. Do you think the index really could double in 3 to 4 years? It could be 4, it could be 5, but can the index double?
No, but I don't think, see, I need to answer this because you just need to look at the history of the Sensex. It was 100 in 1979 and today you are sitting at 22,000, 24,000. So it's up 240 times. And if you count backwards.
240 times.
Yes, 240 times. Yes,
it's a big number.
Yes, it is. And that's what I tell everyone, ki you don't have to do much. You simply have to be patient with equities. And if you simply double your money every 4 to 5 years, 100 will become 24,000 in 40 odd years, 45 years. Our nominal GDP is doubling every 5-6 years. Even last year was a very weak year for the economy. Real growth was 5%, but inflation was 9%. 9 plus 5 is 14%. So when inflation is high, real growth tends to come down, and when inflation is low, real growth will pick up. If you look at last 2-3 decades, the nominal GDP growth in India has been remarkably constant. And I think that is what the Sensex is doing. So I don't think there is any sense in putting a time frame, whether it will take 3 years or 4 years. But P's are below average. Earnings, the margins are at a 17-18 year low, 15-year low. Economy, the worst is behind us. And nominal GDP growth should continue, margins will expand, and there is room for P multiples to expand. And as Nilesh said, interest rates are sitting at a peak. In fact, India is of all the large economies in the world, India is one of the very few countries where interest rates today are higher than the pre-Lehman levels. And that shows the extent of room that is there for interest rates to fall. If interest rates fall, PE multiples should go up. So I think it will happen. There is no point in, it is very unfortunate. People are always stuck with the psychological numbers, 1,000, 2,000, 4,000, 10,000, 15,000, 20,000.
But Nifty level now, that's
no, I am talking of the Sensex because when I started my career, Nifty wasn't around, so I feel a little more comfortable with Sensex. But just look at the history and you will find that these are simply milestones. Which will
okay, when Prashant started his career, Nifty wasn't there. Where is Mr. Chauhan? Okay, too bad he's walked out. Navneet, let me ask.
He started with it.
Yeah? Oh, I didn't know.
Chauhan started the Nifty.
Oh, I didn't know this. Wow. You always live and learn, so thank you for that. Navneet, let me put a straightforward question at you. What are you buying and selling?
I hope, I get lots of money from the investors sitting here tomorrow so I can buy lots. I think mutual funds unfortunately have not been getting money. But having said that, I think more broadly, we discussed a few days back that I think the whole sector rotation, if you believe that we are in for a cyclical recovery, if you believe that over the next couple of years, I think we are going to see the whole economy driven by the revival in the investment cycle and not by boosting through the government consumption, then there are lots of sectors which have been beaten down over the last couple of years who can be a big beneficiary. I think India is regaining its competitiveness across the board. I think there are lots of things that have happened. Companies have done the right kind of things over the last couple of years in terms of restructuring their operations, selling the non-core assets, I think looking at the way they are utilizing their resources, restructuring their balance sheets and all, and I think they would be in a far better position to take advantage of the cyclical recovery. Even globally, though the growth is recovering, of course it's going to be lower, but I think next several years there is going to be a massive infrastructure build-up across the world, whether it's US, whether it's Europe, whether it's several other parts of the world, and I think a good part of corporate India can take advantage of that also. I think the exports from, let's say, the engineering sector can really be a very big theme. So I think there are across the board several opportunities, and you go down the cap curve, forget that the top 20 or 30 stocks, I think there are lots of opportunities.
You painted a big picture for us. Why don't you fill in the colors? What you've done is you've identified the haystack. You like infra, you like cyclicals, you like industrials. But ultimate money is made when you pick up the sharp needles. I understand your compliance. You can't tell me stocks. But give me some basic understanding of your thought process so that I can reach there.
I just mentioned that in the last couple of years we got what $80-90 billion from FIIs that have that was chasing probably a small part of the, I would say, large cap universe, 30, 40, 50 odd stocks, where the ownership has gone up quite a bit. Of course, given the macro challenges here, there was probably, and then looking at the overall, if you put India in the overall emerging market basket. There were a couple of companies that were looking quite attractive for any global investors, and they were looking at that part of the market. And rest of the market, of course, on one side you had the macro challenges with those companies and those sectors, and also became quite under-owned. At some point in time, that rotation is going to take place. In last 1 year, bulk of the earnings growth have come from companies. Almost the entire Nifty earnings growth have come from companies that have benefited from the weak rupee. So I mean your IT, your pharma, your to some extent metals, and then few oil companies, because they got benefit. But a large part, the rest of the sectors which are more driven by the domestic economy have not shown the earnings growth. So in last 7 years, I mean, corporate earnings have grown at a much lower rate than the nominal GDP. I think that will get normalized. In the next 7 years, I think these domestic sectors probably are going to deliver earnings growth in line with nominal GDP, if not more. I think my bet is that they are likely to deliver more, because I think the margin expansion, given the operating leverage and financial leverage which is available, I think the earnings growth can be even higher than the nominal GDP. And then looking at like a variety of
it's like a buffet you can choose right now.